Good morning. It's great to be here in Florida. I think everybody is really enjoying the nice weather, and if you're from the north like I am, what a great couple of days to spend down here. As co-chair of the 6th Revista event, I want to welcome everyone, and my other co-chair, Andrew Haslam, right here, will wave to everybody, but he gave me the responsibility of coming up here and saying a few words. There's a lot packed into these couple of days. There's some great sessions, there's some great people, nice networking opportunities, so I encourage everybody to take advantage of everything that the Revista team has put together for you. And just to give you a few seconds on what we've been doing with it. So at Harrison Street, we certainly invest in medical office and other categories, but in medical office, we've come to use the Revista data almost absolutely exclusively in medical office, and our acquisitions people use it when they're going to a market, our asset management people use it, and more importantly, our investors have come to rely on it. And anybody in the room who's working with investors knows how important it is to have regular, clear, and transparent data. And for us, that's been absolutely terrific. So we've been around with them since the beginning, and we continue to support them. And if you have an opportunity today, and if you're not using the product already, go get a demonstration, see what they can do for you, and see how they can help you move your business forward. So that's all from me. I'm going to now turn it over to Mike Hargraves to talk about the market and some other things. Thank you.
Thanks, Tom. Appreciate it. Hey, thanks, Tom. We appreciate the introduction there, and we appreciate everybody getting up nice and early to come hear us talk about some data and some analysis of what's going on in the market. I think most of you are familiar with our data and data service. We've been around now for 6 years or so. So our trends generally go, five or so years for most of our metrics. And let's go ahead and get started here. So as far as what we're going to talk about today, I'm going to take about 25 minutes or so and go over basically three main things. One is I'm going to touch on the size and scope and growth of the healthcare real estate sector. Second, I'm going to go into some trends, primarily focusing on the top 50 metro areas. That represents about 60% or so of the medical office stock in the U.S. Third, I'm going to touch on some sales transactions and construction trends. And then I'm going to turn it over to Hilda. She's going to take us kind of behind the national stats and focus on construction. She's got some observations about Florida, and then she's going to finish it off with sales and ownership of the sector. So what I would say is buckle up and let's go ahead and get started. Okay, so this is one of the first things we do when we built our nationwide inventory of healthcare real estate is we decided to kind of count them up and slice them up. There was really no consensus back then on really how large the healthcare real estate sector was, or really how fast it was growing. And so we decided that was really our first order of business, to build a nationwide inventory of outpatient medical office properties as well as inpatient hospital real estate properties. And so we update this statistic annually, and it does show some change from year to year. And let me go ahead and go over some of the metrics here. So taking together the hospital, inpatient sector, real estate sector, as well as the medical office outpatient sector, is valued at around $1 trillion. So it's $1 trillion real estate sector. It's got a lot of runway, and it's very large and investable. On the inpatient side, which we're tracking here, general acute care properties, so it excludes a lot of the sort of post-acute, like inpatient rehab hospitals and different other types of specialty hospitals there. But on the general acute care side, there are about 5,500 properties throughout the United States, representing about 1.5 billion square feet, and we ascribe a market value of about $600 billion in real estate value. That's just the real estate value of the inpatient hospital real estate. On the outpatient side, we have 36,000 properties, again, about 1.5 billion square feet, and we ascribe a market value of about $420 billion. So interestingly, this is the first time that we've done this update that the outpatient sector has been equal in size, the 1.5 billion square feet, to the inpatient hospital sector. And so this is sort of a trend that will probably continue into the future. When we look at the medical office outpatient center, one of the things we can do with our data is slice it up by ownership type. And so we have four categories of owners here: provider, government, and other. These are users of the real estate. Those are the light powder blue. The hospitals and health systems are in the gray. Private equity, which comprises both institutional grade private equity as well as local commercial real estate firms that own real estate, are in the green, and then real estate investment trusts or REITs are in the blue. And so the big takeaway here is roughly 2/3 of the medical office sector, this is by square feet ownership, is user-owned. The hospitals own over half of it, 52% of the square feet out there. When we look at the investor side, they own roughly about another third. REITs own 11%. They own about 160 million square feet worth of medical office space. And then private equity investors, again, both institutional grade private equity as well as local commercial real estate services firms, own about a quarter of the real estate out in the sector. Okay, I got a couple of slides that have a lot going on here, so let me slow it down a little bit and I'll kind of explain what we have going on here. So one of the other things we can do with the outpatient sector is we can show the growth over time of the sector. And so this chart, let me go ahead and explain it. This is a chart that shows the total amount of medical office or outpatient square feet opened by year. That's the left-hand side of the graph there. And then the color scale, which ranges from dark blue to dark brown or orange, represents the average size of an MOB built in that particular year. So the darkest blue you'd be at is 68,000 square foot MOB, and the darkest brown or orange, I don't know exactly what color that is, would be roughly 33,000 square feet. So we have two main observations here. Number one, the inventory is growing again in the sector. So inventory growth for the MOB sector peaked in 2008. We had about 36 million square feet that were delivered back in that year. But as you see that the Great Recession unfolded, really between 2010 and 2014, inventory growth fell by 50%. We were just averaging 17 million square feet per year during those years. But since then, the inventory has started to pick up a little bit again. We've been averaging over 20 million square feet since 2014. And preliminarily, this is going to change throughout this year, but we have a fair amount in the pipeline right now. And we're expecting, as of right now, a little over 30 million square feet to complete in 2020. The second observation is that while the inventory is growing again, it's really growing primarily through the building of larger medical office buildings than we used to build. So you can see here that from 1985 to 2004, really a 20-year period, the average size of an MOB built during those years was 38,000 square feet. But since 2011, the average size of an MOB has really grown substantially, that has been built in those years, to a little over 52,000 square feet. And in 2020, as of right now, again, this may change, but the average size MOB scheduled to open is currently 68,000 square feet. So we're growing the inventory again, but through larger buildings that are being delivered to the market. Okay, we're going to switch now to some trends that we've developed on the top 50 metro areas. As you may know, we've been tracking occupancies and rents and rent growth and some other metrics for medical office properties since the middle part of 2016 in the top 125 metros. We'll focus here on the top 50 metros. Again, I mentioned earlier, but the total amount of space, there's about 787 million square feet in the top 50 metros. That represents about 60% of the nationwide stock of medical office properties, so it's pretty representative. So this is a basic supply-demand trend. It's about a year and a half long. So we have, in square feet, we have the absorption, quarterly absorption, which is the amount of occupied space that changes from one quarter to the next. And you compare that against quarterly completions, which is also in square feet, which is the amount of net new construction that hits the market in that particular quarter. And then we have the occupancy rate down below. So you can see at the top 50 metro level, the occupancy rate is remarkably stable. We're trending really between that 91.0 to 91.3 range during this time. It bounces a little bit back and forth, but so far we don't really see a measurable trend there. You can see that absorption, which is a very positive metric when it's positive, not negative. It's grown in the fourth quarter of 2019 when over 5.8 million square feet was absorbed. So that's 5.8 million additional occupied square feet in fourth quarter 2019 compared to third quarter 2019. But completions also rose to 6.9 million square feet. And then based upon the last slide that I showed, where we're showing inventory picking up, I would expect in 2020, we should expect that both absorption levels as well as inventory growth levels or completions should continue to rise going into 2020. When we look at rents, we've also been collecting rents in the top 125 metros. Again, this is the top 50 metro areas. We have a little bit of a longer time series, so we can go all the way back to the first quarter of 2017. This is the 90th percentile base rate. So we collect several types of rents. One, we collect base rent numbers, which is just the number we observed in the property that particular quarter. So we don't discern between types of rents there. But then secondly, we also track the triple net rent. This is not an adjusted metric. It's just really the observed properties that have triple net rents that report to us in that quarter. That's the predominant rent that is in our database, and so that's the one where we trend the most. But you can see here, we're trending the base rent 90th percentile, the average triple net rent, and then we're on the right-hand side, we're looking at same-store year-over-year rent growth for the properties. And so a couple of observations here. One, the triple net rent has risen from $20.97 in the first quarter of 2017 to $22.32 in the fourth quarter of 2019. But interestingly, the 90th percentile base rent has been growing at a faster rate than the triple net rent. Again, that's not same store, but you can see there's more upward movement on a percent basis in the 90th percentile rent. It's gone from $31.76 a square foot to $35 a square foot in this graph. Same store year-over-year rent growth is generally a low kind of around or a low 2% story so far in our database. That's slipped to 1.8% in fourth quarter of 2019. We'll keep an eye on it to see if it's some measure of an emerging trend or if it's just an anomaly in the next few quarters. So that's rents. So I mentioned that the fundamentals, the occupancy trends are pretty stable when you aggregate all the top 50 markets together. But when we look across the different 50 markets, you see different stories that kind of emerge. So we'll go on that here. This is a map or a graph that shows the average medical office occupancy rate averaged over the past 4 quarters. And the range that you see, the color range, the light blues is the lowest occupied market. So Las Vegas is the lowest occupied market in this graph at 83.8%. To a high, the high occupancy rate, which is currently Jacksonville, Florida, at 95.5%. So interestingly, many of the highest occupied markets are located on the coasts. So the coastal markets like Baltimore, New York, and Boston are all about 94% occupied. Portland, San Francisco, Seattle, and San Jose are also all around 94% occupied. Interestingly, many of these higher occupied markets also have some of the lower rent growth of the top 50 markets. So this is a map similar to the last map, averages out same store year-over-year rent growth, averaged out over the past 4 quarters, and the yellow or the gold is the lowest amount of year-over-year rent growth, and the darker reds or the oranges are higher levels of year-over-year rent growth. And so when we look across the top 50 markets, again, I mentioned that some of the higher occupied markets have lower amounts of year-over-year rent growth. And so Jacksonville, which has the highest occupancy rate, also has the lowest amount of year-over-year rent growth in the top 50 markets. Baltimore also has a lower amount of rent growth, as well as Portland also has a lower amount of rent growth. Las Vegas, which has the lowest occupancy, also has one of the higher amounts of year-over-year rent growth in the market. So this was a little bit of a head scratcher for us. So what you do when you can't figure something like this out is you do one of these fancy plot graphs. And so we went and compared across the top 125 metros. We looked at same-store rent growth, again, averaged over 4 quarters, to the average 4-quarter occupancy rate in these top 50 metros. And generally, we don't see much of a correlation with regard to occupancy and rent growth, which is a little bit different than you see in a lot of other asset classes like multifamily or office properties and maybe hotels. Really, if anything, we see that there might be a slight relationship between higher rent growth and lower occupancy. And so when we think about this, the way that we can think about this is that it might suggest something to the fact that markets that have a little bit more space available in the medical office sector can kind of actively market that space available. There's a little bit more action in a market like that, and they can set rates at more prevailing market rates compared to these higher occupied markets that might have a lot of in-place leases that are growing a little bit slower rent growth-wise. And so this is something we'll continue to monitor going forward, but it is counterintuitive to what we see in other commercial real estate asset classes. Okay, we're going to switch and talk about transaction activities. So the first graph I'm going to show is hospital transaction volume. It's up in 2019. This is mostly third-party investors that are buying the real estate, but there's also some hospital-to-hospital transactions here. We're usually able, when we get pricing, we're usually able to tease out the real estate value of these transactions. So when we look at 2019 volume was up. It was at $5.9 billion. That's up 69% from 2018, driven largely by Medical Properties Trust had a very active year purchasing hospital real estate. On the MOB side, what we're seeing is that we're seeing lower volumes compared to the last few years, but continued strong pricing on the MOB side. So this is for the U.S. We moved out of the top 50 metros here. This is the annual volume on the left-hand side, transaction volume, the average cap rate on a TTM basis in the middle, and then the average price per square foot on the right-hand side. And so you can see preliminarily we're at 10.3 billion for the end of 2019. That number will change as we continue to flush out transaction activity. The cap rate, you can see it's 6.4, but if we extended that out another decimal point, you can see it's still kind of compressing. It's really at its low point in this graph. And then the average price per square foot at $328 a square foot is also at a high point on this graph. So that's MOB transaction. When we look at the MOB sector, again, this is contingent US. We look at who's doing the buying. So this is total transaction volume trended on a yearly basis, and we slice it up by the total amount of dollar volume by who's doing the buying. So the four groups are hospitals and health systems, the dark blues are private equity, private investors, the light teals are provider owners, and the reds are real estate investment trusts. And so REITs which were fairly quiet last year, except for one really large REIT, have picked up their share so far in 2019. They've grown from 19% in 2018 to 33% owning 33% of the transaction activity. Private equity is still really dominating the transaction landscape. As you know, debt financing is available, and at 55%, they've really maintained the majority share of the transaction activity in the sector. Okay, I'm going to finish up my part with construction, and then I will hand it over to Hilda. So this is the construction pipeline for both hospitals and medical office buildings. It compares the total pipeline at the end of 2019 and compares that to the total pipeline that we observed at the end of 2018. This is mostly in progress construction for the first three metrics that you see, the first three rows. So it just measures the amount of construction that's currently under construction at the end of that period. So we mentioned earlier about some of the inventory growth that we were seeing on the MOB side. You can see it here in terms of the pipeline. The pipeline is up pretty significantly. There's 732 medical office buildings that are under construction at the end of 2019. That compares to 617 that were under construction just 1 year ago. Also, much of the larger starts in terms of volumes, which I'll touch on in a few minutes. On the hospital side, the number of hospitals that are under construction is down year over year, but you can see that the total amount of square feet, the total amount of dollar volume is actually up. That's representative of, we might have fewer hospital expansions that are going on right now, but we also have more brand new hospitals as well as replacement hospitals that are under construction at this point compared to a year ago. So I mentioned that medical office starts are driving the medical office pipeline higher right now. And you can see this is a graph that shows the amount of square feet that started on a trailing 12-month basis. And then the blue kind of squares measures those start levels against the amount of medical office inventory in the sector. So you can see that we started 27.6 million square feet in 2019. That's the highest level of starts that we've seen in this sector. That's up from 21.3 million square feet at this time last year. When you look at these higher levels, even though they're higher levels, when we look at it compared to inventory, you can see that it all of a sudden becomes manageable. So when compared against inventory, even at these higher levels of starts, we're just starting 2% compared to inventory. Trailing 12-month construction starts relative to inventory in percent basis is a good indicator of future growth of the sector. So expect roughly about 2% growth in the MOB sector over the next year or so. The development section or session, I think it's called Development 2020, which is today. This is going to dive into some of these metrics on development, so please visit that. And then my last slide, and I'll hand it over to Hilda. When we look at where the growth is, this shows a map of the top 50 metros and provides the fourth quarter medical office construction pipeline compared to inventory. So the larger circles represent markets that have higher levels of construction compared to inventory. And you can see it's overlaid by the population growth expected over the next 5 years. So the lighter yellows are lower population growth, and the darker green type areas are higher population growth. And so you can see that much of the markets that have higher levels of construction compared to inventory are located in the Southeast, or even overlaid on some of the demographic growth markets. Charlotte, North Carolina has the highest amount of construction versus inventory right now. Amongst the top 50 metros, there's 1.4 million square feet under construction. That represents 14% of existing inventory. So a lot of construction in the Charlotte market. Richmond, Virginia is second at 13% construction versus inventory. Florida's actually got a few of the markets that make the top 10. Orlando and Tampa actually make the top 10. So a lot of growth in the Southeast or in growth markets. And with that, I'm going to stop and I'm going to hand it over to Hilda. She's going to take a little bit deeper dive into some of these stats.
All right, thanks, Mike. So we'll take some questions at the end for both of us. But to get started here, where's the clicker? All right, so I really want to dig into construction. 2019 was the biggest year for outpatient starts since we've been tracking the data. In fact, in 2016, 2017, we even saw a little bit of a moderating, likely due to the reimbursement changes for hospital outpatient departments. So why the spike in 2019? Is it pent up from that period? Is it response to some sort of market shift? Why in particular last year? I want to look at the who, I want to look at the what, and I want to look at the why, and then look at Florida. And then I've got a few insights on sales and ownership. So that 28 million or so that started last year, it's overwhelmingly hospital affiliated and off-campus. So these two charts show you the totals over the last few years. The one on the left shows you affiliated at 71% of everything that started as hospital affiliated, 70% off-campus. So the last few years, it's always a little bit more off-campus than on-campus, but it's been running around the low 60 percentages. So 70% is a pretty big uptick, moving away from the hospital campus. I looked at these projects looking for some themes. One of the things that I noticed is there are a lot of projects that are repurposing retail locations, significant number. And this makes sense. I mean, retail's going through a lot of shifts. A lot of the big retailers, those big box stores are closing. And there's a lot of ways you can repurpose these. So you could have warehouse, manufacturing. Medical is a big use for them. And there's quite a few of them across the database. And it ranges in terms of how much you do to this space. If you look at the Macy's location here in New York, HealthQuest, they only renovated it somewhat. And then the Kmart, this is Henry Ford in Detroit, they completely wiped that out and rebuilt. So there's quite an array of what you can do with these locations. And there's a lot of pluses to this. They can be cost effective. Some areas you'll get tax credits. You've got great parking. And they're often well placed because it's retail and you're looking to bring services to the community, and they're already placed near those demographic groups. I can't talk about repurposing without at least bringing up hospital inventory. We've got the old Copley Hospital here as an example. This one started last year, but there's a lot of old hospitals that need to be repurposed. They're not all going to be medical, but some of them are repurposed to different medical, which this one will be. This one is going to be urgent care, lab, surgical center. It's even got some seniors housing. Fox Valley developers had to basically strip this down to shell because it's been sitting vacant since '94, but it looks like they're going to have a pretty good project there when it's finished. So Mike talked about how not only do we see this uptick in starts, but the buildings are getting bigger. This looks at the last 5 years and the number of outpatient projects that started that were 100,000 square feet or more. So typically that's around the 50 project mark. Last year, 77 projects started that were 100,000 square feet or more. So quite a big uptick in those larger buildings. Top 10 in terms of size in our database. Parkland Memorial Hospital has a 500,000 square foot MOB they are building. This one's a good example because they're moving services from the old Parkland complex into this MOB. Again, that space is currently for sale. And they're also going to have a new comprehensive breast care center in there. Rush broke ground in June on a $450 million cancer and neurosciences center opening in 2022. But aside from some of these monster projects, there is a theme amongst these larger buildings, and that is they tend to have an array of complementary services. It's sort of a one-stop shop. I know that my doctor referred me to a specialist or two over the years, and I'm going to several different locations for lab. I'm going somewhere else for imaging. This specialist is in another building, and she's asking me to go get records for tests I've had done, and I have to go through this whole rigmarole just to get all of this and email it to her, and it just is so complicated going through this whole process. When you have all of the services in one location, one patient record system, it's much easier for the patient, and it makes it sticky. It makes your brand sticky. So you see sort of what they're doing with this strategy in terms of complementary services. It's going to have primary care, the specialty services, lab, urgent care, a pharmacy on site, just making it easier for patients or consumers. A couple examples of that. I put VA Health on here. I realize it's a different dynamic, but they've got so much under construction right now. 33 projects are currently underway, and a number of them are these multi-specialty outpatient centers. UNC has 2 Panther Creek and Easttown in Chapel Hill. They've got cardiology, urology, hematology, a whole long list of everything they have in one of these buildings, and they purposefully put this together with primary care to have a more holistic approach for their patients. Beaumont in Detroit started on 2 of these type projects last year, and again, they have that whole array, as well as urgent care. So after hours, instead of going over to patient first, you might go a little bit further to come to this Beaumont location because they already have all of your information. It's easier to follow up, and you're building that brand. So digging into these, I wanted to kind of figure out, is there more to the why? And I came across some interesting stats. This is from the American Hospital Association, and it's a report that's not even out yet. It's coming out, I think, the 31st of this month. But for the first time in 35 years, outpatient visits for hospitals are slightly down, which is completely counterintuitive, and I had to double take on it, because I'm thinking, outpatient or inpatient, but it is indeed outpatient. The American Hospital Association says this is a lot to do with emergency visits. Revenues for outpatient is still up. It's just the number of visits. Now this isn't as recent, it's just coming up to 2015, so this is just a developing trend here. But this is just low acuity conditions, and it's showing the emergency department visits versus urgent care. You clearly see urgent care on the upward trend and the emergency room visits on a downward trend for low acuity conditions. Now this is good because you want those types of services to go in a more cost-effective setting. The downside is that urgent care as a whole is 70% independent. Only 30% is owned or affiliated with a hospital system. So 70% have patients coming into them. Where are they referring them? Where are they going? So it's being able to capture those patients when they have more complex conditions. A third of the people that go to an urgent care don't have a primary care doctor, so they're looking for some sort of referral when they have something more complex. And you do see this construction on the part of hospital systems and the strategy they're using to really build patient loyalty could at least partially be in response to this. So hospital performance is really important to the outpatient inventory that's near it. I wanted to take a look at all of the MOBs that are close to hospitals. For the sake of this chart, it's within 2 miles, and look at whether that hospital is profitable or not profitable and how it affected occupancy. It's actually a fairly significant difference. So this is looking at all hospitals that have a positive EBITDAR versus a negative EBITDAR. So, and it's 867 so hospitals that are negative, 18%. So it's a pretty big portion of them. And depending on how not profitable, you're going to see even more of a wide variance. But 200 basis points roughly between MOBs within 2 miles, I'm not even talking on campus or adjacent, within 2 miles of a hospital that is not doing well, absolutely will affect occupancy. So something just to keep in mind going forward as you're analyzing buildings in your portfolio or looking at acquisitions, that nearby hospital is so important. So Florida, what makes Florida different other than you might get hit by a falling iguana? You know, they always are telling me, you've got snow up there, it's so cold, but you have falling iguanas. So I'm not going to tell you anything you don't already know here. Florida has an older population. So across the US, 16% of the population is 65 plus. In Florida, that number is 20.5%, which is a pretty significant difference. Across the US, that 16% of 65 plus represents 27% of healthcare services. So you've got a big demand for healthcare in Florida. And you know, looking at this, I would think that because you have an older population, you probably don't have a really high growth in population because deaths could potentially outweigh births or at least cancel them out. Which is true in Florida, that those cancel out, but it's one of the fastest growing states in the US. And all of that's made up from domestic migration and immigration. So everybody's moving to Florida. And again, you've got a lot of seniors retiring in Florida, so you're maintaining that high proportion of senior citizens in Florida that need care. So all of this is getting at, in Florida, you need a lot of health care, and you can see this in the construction stats in Florida. Here's a few metros just to take a peek. So in the top 50 metros, 4% of inventory is under construction. Pretty much every metro in Florida goes above that. In fact, in Orlando, you're almost double. You can see here, Mike mentioned Jacksonville earlier. You've got them up here in terms of occupancy. We've got rents, we've got rent growth. But again, I want to dig just a little bit further on the construction. This is the whole state. These are all the outpatient projects underway. You can see how they're clustered around that Orlando area. There's some big projects down around Miami, around here. In case you were wondering, this is where we are. And one thing I saw, so you've got 60 projects underway, 14 of them are freestanding ERs. That's a significant portion underway that are freestanding ERs. And this is a strategy you've got a number of systems using, sometimes to alleviate pressure from an existing hospital location. It's another way to get out in the community, and it's another way to build your brand. In particular, HCA, so there's 80 of these total in Florida, including these 14. And HCA has 20 of them, 2 actually underway. This is part of a more broad strategy across their footprint. They're big across 21 states. And it's not only freestanding ERs, but also urgent care that they're putting up. You've got Orlando Health, Baptist Health, Advent Health has 5 currently under construction. And this isn't the only place where this is a trend. I mean, overall, across the whole U.S., and this is information from the Bureau of Labor Statistics, you can see that growth. So over 10 years, yes, you're going to see a huge amount of growth in freestanding ER employees, but even just in the last year, it's double the growth of all of healthcare or hospitals. All right, just a couple more to talk about. One is ownership. So looking at these hospitals, and Mike showed us a chart of all of ownership, and you can see that it's overwhelmingly user-owned. The picture is a little bit different depending on what and where you look. So as we know, generally, hospitals tend to favor owning their on-campus MOBs. So 62% of the inventory that's outpatient on a hospital campus is owned by that hospital. Only 38% is owned by a third party. Off-campus, 57% is owned by a third party. So they're affiliated buildings. 3 miles away, that moves to 65%. So 3 miles away, 65% of the outpatient affiliated inventory is owned by a third party. Overall, over the last number of decades, there's been more and more inventory that is more than 3 miles away from a hospital. Back in the 70s, that stat's only about 10%, and we're all the way up to around 17% now. So there's continuing to be that move further and further away. And it's worth mentioning that the risk profile is a little different the further away you get from a hospital. You're more beholden to the population and dynamics around the particular area that you're in. It's sort of the destination medical hospitals where you're coming there to get health care versus the convenience of being in the community. There was an article in the Wall Street Journal a few months ago, and they talked about this massive volume of homes that are going to come online for sale as the baby boomer generation gets older and moves in with a family member or eventually pass away. In some areas, it's really condensed. They mentioned Sun City, Arizona, and what an impact it's going to have on that community when so many houses come on the market. It's true in any area that over the long term, there are shifts and things that make you a little bit more vulnerable and potentially more insulated being on a campus that's a destination for healthcare. So last but not least, who is selling? So we see all the volume, but who's selling these buildings? This is over the last 2 years, percentage of total volume. And the interesting thing is 78% of everything that's sold outpatient in the last 2 years was sold by an investor, either a REIT or private equity. 13% was sold by a provider, 9% by a hospital system. Some of that, though, is hospital to hospital. Of the 900 or so trades last year, only 150 so were from a provider going to a third party. 50 some were from a hospital. So, and this tends to be a trend that's somewhat the same ongoing, that percentage is how much is being sold by a third party. And it's not that there aren't opportunities there are, but you're just seeing a lot of the sales coming from third-party investors. And since you have all the folks in this room, a lot of you being third-party investors, I don't know, maybe your next opportunity is here. You want to do some questions? Okay. All right, well, if we don't have any, thank you.
So it's a really good question. The fact that much of the hospital construction that's out there, how can we still be showing declining overall bed trends? And to answer that, I would say that you're right, Mike, the vast majority of hospital construction that's going on, like expansions when they're building even a new patient tower, that overall campus likely will have fewer beds at the end of that project than they had going in. They're converting a lot of the rooms to private. They're expanding the services that are revenue generators for the hospital, like surgery bays, emergency departments, cancer centers. But there are, despite that, there are, and particularly in these demographic growth areas, there's a fair amount of brand new hospital construction. I believe there's almost 150 either brand new hospitals or replacement hospitals that are going up. And yes, the average bed size of hospitals like that is not what they used to be, but it's not that there's no new growth in the number of beds in a certain region, particularly in like a high demographic growth area. A brand new hospital might be being built that's 250 beds or so. So you do see growth in those types of areas, but overall, I think when you take all the construction together, net new number of beds, we're slightly down on that trend.
Oh, closures too.
Yeah, and the other thing is we probably average a closure every 2 to 3 weeks of a hospital, and so that also affects the trend. Oh, go ahead, I'm sorry.
Chicago. Yeah.
Yes, so we do track that. Hilda mentioned, maybe Hilda, go over your stat you had of physician groups selling their real estate. Go back to that.
Sure. Yeah, so the lion's share, particularly on the provider side, is them selling to a third party. The hospital, the 9% hospital, some of that is hospital to hospital, but the providers are lion's share sale leasebacks.
Mm-hmm. Sure. Any other questions, comments?
All right. Great.
Okay, well, thanks
Thank you.
everybody. Good picture.
Oh.
Good picture.
Whoops.
Yeah. Oh well.